this is part 2 of the lecture for 8-1. There's one other thing I wanted to add to this before I change from this slide. So if you are a business that sells office equipment, okay, you might think, well, we bought an office computer, right? And we sell office equipment, so wouldn't that be in the purchase journal because we purchased an office computer? Well, there's a difference. If you are using that equipment to run your business, it's going to be an asset, and it's not going to be a purchase of merchandise. It's going to be an asset, a supply, an asset for the company versus. And it wouldn't be a supply if it was an office computer, right? That would be if it was pencils, copy paper, things of that nature. Versus if you buy it to sell, it's actually merchandise. So in that case, if you purchased office computers on account that you were going to sell for your business and that's part of your normal business, then it would go in your purchases journal. So some of you guys are probably sitting there going, what are you talking about? But we talked about special journals. We were covering special journals. And so it's important that we clarify what goes in each journal. Okay, next slide. We are talking about calculating and paying property tax. This is more math. Yay, math. We do way more math in accounting 2 than we do in accounting 1, which I know some of you guys are not thrilled with, but I actually really love math, so I think it's great. Most states, businesses are required to pay taxes on their plant assets. So some have to pay state taxes, some have to pay federal taxes, and we have 2 types of property. We have one called land, and so it's any land and anything attached to it is called real property. So that would be land, and that would be buildings, right? And then we have, and in my case, I have a fence in my backyard, so the fence would also be real property. And then we have all property that is not classified as real property. It's called personal property. And so looking from the aspect of a business, and I don't want you to confuse, I'm a person and I have my personal property like my purse and my wallet and things of that nature, my car. Real property and personal property when we're looking at the aspect of a business. So our school has real property and it has personal property. Real property is going to be our building. It's going to be our portables. It's going to be our track. It's going to be our fence, our parking lots, et cetera, right? Personal property within our school, the desks that you sit in, those are going to be part of the personal property. And we're looking at this from a taxation standpoint. So don't look at it as like, wait, but that's furnishings. That's an asset, right? It is an asset. It's part of what we do to help you learn. But it's considered personal property. Even though it's a school that owns it, so it's not a person, it's a business, it's a school, it's considered personal property. And so those are taxed differently. And that's why it's important that we understand the difference between those two. So we have something that's called an assessed value. And what an assessed value is a value that somebody who's trained to evaluate the worth of property or buildings or equipment, they come along and they look at your property, your building, whatever enhancements you have, and then they say, okay, your property is worth this much for tax purposes, okay? It's not for book value. It's not for financial statements. It's not for, adjusting your books. It's only for tax purposes. And frequently it's not the same as the book value. It may only be a portion of the book value. If you go and you look at the assessed value for a house, for instance, let's say that my house assesses at $400,000, and that's a joke, guys. I'm a teacher. I don't make enough money to buy a $400,000 house. But let's say that my house assesses at $400,000, and so if you go look at the tax rolls, it'll say, property value, and it breaks it down by land, and it breaks it down by building, and it breaks it down by improvements. So I have my land is worth one amount of money, my actual house is worth another amount of money, and then my garage is worth more money, or I should say, when I'm saying worth more money, I mean like for the assessment, right? It increases the amount of the assessment. My front porch increases the amount of my assessment. My back patio increases the amount of my assessment. If I had a pool, it would increase the amount of my assessment. So somebody who's trained, they've been elected, right? They're called a tax assessor. They are the ones who decide the value of your property for tax purposes. So, and this is one of those things that we're going to talk about real estate for a split second. That when you buy a house, they tell you don't look at the tax value, because a lot of people make the mistake of looking at the tax value and be like, well, that's all this house is worth, or, oh, look how much this house is worth. There's a big thing when you buy a house and you don't think that you're going to be in it forever. That they tell you not to like fight or to challenge the assessed value of your house, because if your house is over assessed, then people make the mistake of looking at that assessed value and they're like, oh, this house is worth a lot of money, I should buy it. Whereas, like I said, it's just an assessment for tax purposes. Hopefully that made sense. Okay, so we have to pay taxes, and those taxes are split up. They're part of how we pay for the school that you're in right now listening to this. It's part of how we pay for the computer that you're listening to this on. It's how you pay my salary. It's how we pay the bills to have these lights on, is that your parents or aunts, uncles, whoever, grandparents pay property taxes on their land and on their houses. So this is a really basic example, but what we're saying, you should take the assessed value of the property or the asset, whatever it is, you take the assessed value, you multiply it by the tax rate, and then you get the annual property rate. And this is not actually this easy. The way that we're doing it is like basic. If you look at a tax statement for a house, there's about 6 different tax rates on there and a couple different assessed values. So like, the county assesses my house at more than like what which I paid to one of the community colleges that some of my taxes go to them, and so like the assessed value of my house for them is like a smaller portion. It's really complicated, is my point, right? This is a super cut and dry example of property taxes, so I don't want you guys to be like, oh, I can go be a tax assessor. I learned everything I need to know in 6 minutes and 44 seconds. So anyway, assessed value times tax rate equals annual property tax, right? This is for simplicity's sake for accounting books. So if the assessed value of our property or our asset is $65,000 and our tax rate is 5%, which we could take 65,000 times 0.05, right? There's a decimal right after this 5. It's not written, but we know it's there. If we want to turn this percentage into a decimal, we move that decimal place 2 places to the left. Bam, bam. So 65,000 times 0.05 equals $3,250. This means that we're now going to have to pay the government, we being our business, $3,250 in property taxes for the year. So we have to account for this, right? Which 2 accounts are affected? It's going to be cash for sure, paid cash. So we know it's going to be paid cash. It tells us it's going to be cash. And the question is, what's the other one? Now, I remember when I was in college, I was always like, how do I know which account that it's going to go to? And I would stress out about this all the time in school. And like, I'd take a test and I'd be like, I don't know what account that's going to be. And so I'd say, property tax expense. And it turns out that what my accounting teacher was looking for was, did you understand it was going to be an expense, whatever it was? And now, again, this is, like I said, you have a chart of accounts to refer to. If you're like, I have no idea what account this should go to, you can go to your business's chart of accounts and say, aha, property tax expense. This makes sense. And sometimes a new account needs to be created, right? So, like I said, that was something weird I stressed out over. I don't know if any of you guys ever feel that way, but rest assured, you have something to refer to. Okay, so we have to talk about how we are going to journal this. And again, I messed up my numbers when I was doing my animations. So property tax expense is one account, cash is the other. Normal balance of an expense is a debit. It reduces our capital, right? It's revenue minus expenses. Normal balance of an expense is a debit, always. Normal balance of cash, because it's an asset, is going to be a debit as well. We are increasing the amount of our expense, right? We had no expense, and then we calculated our property tax expense, and now we have $3,250 in expense. We reduce the amount of our cash with a credit because we paid that out. And so the next thing we need to look at is where we journal it. Well, we already determined that if we pay cash for something, it's going to go in our cash payments journal. So we already saw a cash payments journal earlier in this lecture. If we look at this, here's 2014, February 1. The account title is property tax expense. It's check number 122. It's a general debit. So, and this just means that These are general columns. These are special columns. It's not going to go in a special column for the debit. We don't have one for it. And these special columns are just frequently used accounts, right? A lot of time when we're paying cash, it's because we're reducing an account's payable debit, or it's for a purchase discount. So that's why we have special columns for those. Anyway, general debit column, $3,250. Cash is a credit, $3,250. So, and I think I discussed this with you guys last time, but when we're using special journals, cash payments journal, purchases journal, cash receipts journal, sales journal, then we're going to use one less line than accounts that are affected. So if 2 accounts are affected, we're going to use 1 line. If 3 accounts are affected, we're going to use 2 lines, which we saw when we were working with stocks. So all of this will go on 1 line. Now remember, if it's our general journal, we're going to have a line for our debit and a line for our credit. So hopefully that does not confuse you guys. So that is the end of 8-1 officially. That ended up being a much longer lecture than I thought, probably because it's 11:30 at night, and so I rambled a lot, which I apologize, but hopefully you guys picked up some good information in my rambling. And these were just the terms that we covered: a plant asset record, real property, personal property, and assessed value. So if you have any questions, please let me know, and you are going to complete a learning log on this lecture.